How are you, everyone? My name is Mr. J.M. Kimani, a lecturer in management accounting. Welcome to lesson 2, topic number 6, costing methods. Now, in lesson 1, I introduced process costing with losses, and we looked at the normal loss. So we want to continue with the part of losses. We do the abnormal loss as well as the abnormal gain. Now, starting with the abnormal losses. Abnormal losses. Abnormal losses carry their own costs and are valued at the cost of good output. They are separately analyzed and the amount transferred to the income statement. These costs do not add any production benefit to the company and are treated as accounting losses. They are controllable losses which are not expected to occur under efficient operating conditions. Examples: improper mixing of ingredients, omission of some important chemicals in the manufacture of a product, etc. Abnormal losses are considered to result from production inefficiencies that should be eliminated and are not an inherent part of the production process. Now, we are saying that these losses are not expected. They are not inherent in the production. They actually can be avoided. Like if it's about being somehow inefficient, not being vigilant, in the way you are mixing, the way you're doing, you're operating the machine, such kind of causes we are saying can be eliminated, and therefore we would want to know how much cost are we spending on such abnormalities or such kind of causes. So we separately analyze that cost. We transfer to the income statement or the P&L as a loss. When it comes to the normal losses, we say that the cost of normal loss is borne by the good production. But for the abnormal losses, they have to bear their own cost. And that cost, since they don't add any value to the production of this company, we transfer them to the income statement as a loss. Abnormal losses, just as normal losses, may or may not have a scrap value. Abnormal loss with or without scrap value is treated in a similar way in the process account. The sales revenue received from sale of abnormal loss units is offset against the cost of abnormal loss in the abnormal loss account to arrive at the net abnormal loss that shall be transferred to the income statement in the period in which it arises. Now, one thing to note is that while in the normal loss, the scrap value was used to reduce. This one reduces cost of good output. Good output. But when talk of the abnormal loss, we are saying that the scrap value of it is going to reduce. The cost or the loss of the abnormal loss. So now, because the cost of normal loss was borne by good production, even its income or scrap value should also be charged there. While the cost of abnormal loss is charged to the abnormal loss, then even the scrap value of it should be charged in the same abnormal loss, and that's something to note. Then abnormal gain. Abnormal gain. What about it? In some instances, the actual output may be greater than expected, or actual loss may be less than the normal or expected. In such circumstances, abnormal gains are considered to have arisen. The main objective of preparing the process account is to determine the cost per unit of expected outputs. That is now normal output, which is actually the actual input. You subtract the normal loss. In a case where abnormal gains have no scrap value, that is, where if scrap value would have a zero value, the cost per expected output will just be the input cost you subtract or you divide by the expected output. Now, for us to understand these concepts and also in their respective accounts, so we're going to have an illustration. We prepare a process account, the abnormal loss and also the normal loss, or either we have abnormal gain. Now, illustration reads that in August, 2,000 kgs of material were introduced into a process at a cost of shillings 60 per kg. 200 hours of labor were spent at a cost of shillings 150 per hour. Overheads are absorbed at a rate of shillings 40 per labor hour. Normal losses are incurred at the rate of 5% of input, and lost units can be sold for shillings 9 per kg. 1,800 kgs were produced. Required. Calculate the total absorption cost of the good output, the treatment of any abnormally lost or gained units, and also show the process account and loss accounts. Very important. Now, for us to show these, we do have several costs, the material cost and the labor and overheads. Then we need to balance, see the expected loss, which is normal loss, and then we look at the actual output. So in our case, to determine whether you have abnormal loss or abnormal gain, we are going to have this, that we have expected output is going to be the input minus, this is input minus the normal loss, which input is 2,000 kgs minus 5% of 2,000 kgs. So this is going to be, is like saying 95%, in other words, 95% of 2,000. So this is 0.95 times 2,000. This is 1,900 kgs. But again, what was the actual output? We can have here actual output is 1,800, meaning we have a further loss. These are more loss. So we have abnormal loss of 100 kgs. Why? Because the actual outcome is lesser than the expected. We have lost another 100, which was not expected. In other words, we can have it this with this calculation, that we have the normal or expected loss, which is actually 5%. So 5% of 2,000 input, this is actually giving us 100 kgs. But looking at the actual loss, this is actual loss, it is taking the input of 2,000, which is input, we subtract the output. So this is actually the input minus the output, which is 2,000 kgs minus 1,800 kgs. This is giving us 200 kgs. That tells you what? The actual loss is more than the expected or the normal. That means we have abnormal loss now. The difference is abnormal loss. This is abnormal. If the situation was opposite, like we have the actual output which is more than expected, it would have been abnormal gain. If the actual loss would have been lesser than the expected, it would have been abnormal gain. But this time we are having abnormal loss. Now, to present this using the process account and the loss accounts, we can have this. So this is process account. We have the format of process account. This is details. We have units, price, and you have value. Details, units, we have price, and you have value. So these columns are important to present our information concerning the inputs and outputs. Remember, the debit side of this account is for the inputs, the credit side is for the output. So for the inputs, in terms of units and also cost, we do have here material. So this is input material, which is actually 2,000 kgs. And the price of this is 60 shillings. This is going to give us 120,000 as the input value for materials. Then you have the direct labor. The labor we have been given there 200 hours. So we cannot put the 200 hours here because we are talking of physical units of input and output, not the hours. So we are going to have dash here, but we know that is the computation of this labor. It was 200 hours and the rate is 150 per hour. So 200 hours times 150 per 1 hour. This means we are having 30,000 as the direct labor. Then you have the overheads. Overheads, we have been told it is charged or absorbed at 40 shillings. So it is 200 hours times 40 shillings. This is 8,000. This is 8,000. So on that note, looking at the output, because these are the inputs, the output, we are having here the normal loss, which we have calculated and found to be 100 kgs. Now, this time, we do have scrap value. We are told that we are selling the scrap value at a price of 9 shillings. Now, remember, just like the way you can have in a sawmill, you are able to have some losses. If we take the sawdust, let's say to be a loss, or we take some pieces of timber to be a loss because they are not the same state of the actual or the correct timber that you should sell. So that even so, if though you're saying is a loss, it has some value. So that is the value you want here. That even though we are having 100 loss, we can sell this one for shillings 9. So we normally record the scrap value in the process account for the normal loss. So this is going to give us 900 shillings. Now, just like I had given the explanation here that the cost of normal loss is borne by the good production, therefore even the value or the scrap value of normal loss should be charged to the good production. So in our case, our total, so let me have here balancing the units. We do have abnormal loss, which is 100, so that you can have now the output or good production. So this is a finished goods, which is 1800. So this will give us our account. We want to estimate the length of the account. So we are having such. This is the length of the account, so that you can have the workings here now. So we have the workings here. That the cost of good production, so this is cost per unit of good production equals to